My next area in which I do analysis is called liquidity. Now, liquidity talks about my ability to use my current assets in order to pay back my current liabilities. Now, there's two very important ratios that forms the key to liquidity. The first ratio is called the current ratio, and the second one is called the asset test ratio. Now, the current and asset test ratio cannot be done separately. They would always be done together. This is almost like my binoculars, where I use this as my center lens, and if I then find a problem in any one of these ratios, I will zoom in even further to my other four calculations of liquidity. Now, the other four calculations of liquidity is your average debtors collection, your average creditors payments period, your rate of stock turnover, and the months of stock on hand. So in other words, if I find that there's a problem in my two main ratios, the asset test and the current ratio, I can go and do further investigation in any one of the four areas. Four areas meaning either debtors, creditors, or stock, either stock rate or stock on hand. Now let's look at the first ratio together. The current ratio talks about current assets to current liabilities, and I always change my current liabilities to become 1. How do I change it to become 1? I simply take whatever is there, divide by itself, and then I get 1. Now remember to always compare the current year's ratio to that of the previous year. A good answer, comment. The acceptable norm for this calculation is 2 to 1. If the ratio is more than 2 to 1, we say that the liquidity position of the business is very good. If, however, it is less than 1 to 1, we say that the liquidity position of the business is not good at all, and ways and means must be found to improve the situation. In other words, then I zoom in. I've now seen that there's a problem with liquidity, so I can zoom in either into debtors or into creditors or into stock. So I can go and see whether either I must encourage my debtors to pay more quickly, to bargain with my creditors for a longer settlement period, or to increase the stock turnover rate. My second ratio then, that is in support of the first ratio, the current ratio, is your asset test ratio. It looks very similar, but there's one very definite change. And that definite change is the formula changes to say not just current assets to current liabilities, but I take all of my current assets, but this time I subtract my inventory. If I subtract my inventory, I'm basically left with current assets only being my debtors and my cash and cash equivalents. So remember to always compare the current year's ratio to that of the previous year. Now, an acceptable answer in this ratio needs to be more than 1 to 1. My norm is 1 to 1. If the ratio is greater than 1 to 1, we say that the liquidity position of the business is very good. If, however, it is lower than 1 to 1, we say that the liquidity position is not good at all, and ways and means should be found to improve the situation. Again, we zoom in to find where exactly is the problem. Is the problems with my debtors? Is the problems with my creditors? Or is the problem with my stock? So either debtors, creditors, or stock will then tell you which of the further calculations are you going to do. So which one of the other 4 calculations will you do to pinpoint where the problem is actually lying in terms of liquidity. So if we're anticipating that the problem lies with my debtors, I will go and do an average debtors collection period calculation. Now, an average debtors collection period calculation says it's your average debtors over your credit sales times 365, because I want my answer to be given in days. Please take note. How do I get average debtors? I take the opening balance of debtors control plus the closing balance of debtors control, and I simply divide it by 2 or times it by half. So if you found that there is a problem, this is very important liquidity ratio. An attempt made to collect debtors' obligations should be within 30 days. The faster the money comes in, the better it is for the cash flow situation of the company. Debtors can be encouraged to repay quicker by offering discounts or imposing interest charges on accounts that is in arrears. Please, when you answer this question, however, you offer discounts on early payments and you charge interest on overdue accounts. If we found a problem with our current or asset test ratio and we think the problem lies in creditors, we can go and do a creditors calculation, the average creditors settlement period. Now, to calculate average creditors settlement period, we take our average creditors over credit purchases, and again we times it by 365 because we want our answer to be in days. How do I get average creditors? You take your opening balance of creditors plus your closing balance of creditors and you divide by 2 or times by half. Now, if credit purchases is not given, I can go and take my cost of sales. If I, however, take my cost of sales amount, then I go with the assumption that all of my sales, or all of my purchases, however, was made on credit. This is also a very important liquidity calculation. An attempt is made to bargain with the creditors to repay them within 90 days. The longer we can delay payments, the better it is for our cash flow situation. Because remember, we keep the cash in our hand for longer. That enables us to use that cash for other things first before we need to pay it back to our creditors. It is here that bargaining power plays an important role, e.g. through bulk purchases, good credit, or repayment records, and a long-term relationship. So the longer or the closer we can have this answer to 90 days, the better it would be for our cash flow or liquidity position. If we see that we have a problem in liquidity and we want to go and look if the problem maybe lies in stock, we have two calculations that can point us towards possible problems or areas where we can better our stock. The first is the rate of stock turnover. Now, the rate of stock turnover is your cost of sales over your average stock. How do I get average stock? I take my stock at the beginning of the year, I add that to the stock of the end of the year, and I simply times by half or divide by 2. I don't times it with anything here because I want my answer to be in times per year. Now, very important that this represents the number of times the stock was replaced or sold during a financial year. So in other words, times per year tells me how many times did I have a complete stock turnover. From buying to completely selling out that stock, how many times did that happen this year? Now, the turnover of inventory must be compared with that of the previous years to see whether the rate has improved or weakened. It is also important to look at the turnover of similar products to be able to come to a conclusion. In other words, if this is a company that is selling fresh fruits and vegetables, I'm expecting their turnover to be very high, because at least once a week they need to sell out, because otherwise their stock will go off. They will need to throw it away. Compared to, say for instance, a car dealership. A car dealership will have a very lower stock turnover rate, because you simply don't sell cars as fast, and there's also not as many new cars that comes out as frequently as fruits and vegetables. So it's very, very dependable on the product that you are selling. The next calculation of stock has to do with the number of months that you have stock on hand. So now I just flip that calculation of rate of stock turnover, and I flip it over and I see my calculation reads average stock on top and cost of sales at the bottom, and I times it by 12 over 1 because I want my answer to be in months. You can also times it by 365 over 1 if you want your answer to be in days. Now this represents the total number of months for which there is enough stock on hand. It also determines when stock must be replenished and encourages good internal control of stock. So in other words, if I see that the answer is 2 months, then I know that the stock I've got currently on the floor or in my shop or in the company's warehouses, that stock will last me still for another 2 months before all of that is sold out. So it gives me an indication of how much time I have to play with in terms of buying new stock. Also, you don't want your stock on hand to be too short, and you also don't want it to be too long. Too short means that you run the risk of running out of stock and having very, very unhappy customers. Too long means that the stock that you've got now is going to take so long before you need to buy new stock that customers will come into the shop and see the same old stock the whole time. So you want a balance between being too long and too short, and that again depends on what is the product that you are selling.